sleeps, pal.
Hey there, I'm Pete Townsend, and this is Money Never Sleeps. We look inside the minds of entrepreneurs and at the crossover of startups, enterprise, finance, technology, and life as we know it. This episode of Money Never Sleeps is sponsored by Pat FinTech, the training partner that demystifies fintech and digital finance for financial services professionals. Owen Fitzgerald and I are back with another Money Talk segment this week. We get into the onslaught of crypto's mainstream moments in the past 2 weeks. We dig into BNPL, or Buy Now Pay Later, for the first time with a look at Klarna. We pick through Tiger Global's supersize appetite for deals previously the purview of VCs, and a whole lot more on this week's episode of Money Never Sleeps.
Money never sleeps, pal.
But listen, we got a lot to cover tonight. We've got crypto is on fire, and never mind the price movements, it's just everywhere. It's all over the news. It's all over the press. The press is the news is the press, the media, you name it. And there are a few things that we wanted to mention tonight, yeah?
Yep.
The first one, our pal Elon Musk was on Saturday Night Live over the weekend. Obviously, guess which day that was?
Sunday, I presume.
Yeah, exactly. Well, it was Sunday here. And,
Sunday here, I know, late. Yeah, I saw on Twitter. It was up on late, 11:30.
Shout out to Gray Webb, who down in Hong Kong, who sent me the link for some international streaming. So it would have been 4:30 our time, but I never got to get up that early to watch it. Anyway, I think aside from the joking sentiment of him calling his mom up on stage for Mother's Day and saying that he got her a Mother's Day present, and her saying, I hope it's not Dogecoin. And he said, actually, it is. There's the story that we're kicking off with is Noelle Acheson in Crypto Long and Short. She's a writer for CoinDesk. She also does her weekly newsletter. And it just came out this Monday. And the title of it was Dogecoin is Getting People Worried. And just to kind of put it all in a nutshell, that one of the quotes from what she wrote over the weekend was, as SEC Commissioner Hester Pierce said in a recent appearance on CoinDesk TV, if investors are just having fun, i.e. with Dogecoin, they can do that as well, but don't come complaining to the government if you lose your money, right? So I think the thing with Dogecoin, with it being created as a joke, it hung around prices of 0, 1 cent, 5 cents for a long time. And then with the activity in the past year, that's getting pumped up to, I think, as high as maybe 72 cents before Elon went on to Saturday Night Live. And he's been talking about Dogecoin and Twitter and to the moon and all that type of stuff, right? So it's just that when Dogecoin was created as a joke, you got to imagine that the Dogecoin blockchain isn't very secure, right? And that's the thing with blockchains, is that there can be a takeover if 51% of the nodes colluding, right? When you got over 70 billion locked into one blockchain that was created as a joke, that's where people should start to get a bit worried, right?
Yeah, to me, it just actually, it almost makes a mockery of the progress that's being made. So look, I'm kind of still on the fence about Bitcoin, but seeing what's happened with Dogecoin, and even Dallas Mavericks are accepting it as a form of payment, it's all great and great fun. But like, it makes a mockery of the real progress by being a comparable out there in the market to Bitcoin. So they've taken the retail investor madness that was going on with GameStop and brought it to something that's probably more affordable for people to just throw money into and play around with. But it really is, to me, making a mockery and drawing negative attention to cryptocurrency then.
Yeah, a bit. And you know what? I kind of had one part of me zooms out and says that's okay. You know what? We got a long, long way to go here. But the other part of me is slightly annoyed. But you know what? How many people out there are slightly annoyed or more at just Bitcoin, right? Like Charlie Munger, who is Warren Buffett's longtime pal, who said in their, what's the name of the company?
Berkshire Hathaway, in their annual.
Yeah. So it was at Berkshire Hathaway's annual meeting where Warren Buffett was asked first, and he said, listen, I thought I'd be asked about this, and I'm decided I'm not going to comment on it because there's other people who are probably know a bit more about it than I do that are more willing to comment on it. And then Charlie Munger
pipes up.
It's disgusting.
Yeah.
So, and I thought that sentiment juxtaposed against Noelle Acheson's more pragmatic insights from the week before, right? Yeah. Where she's talking about Bitcoin's potential as a collateral class, and she's holding up a few things, right? She's saying, let's look at the value of Bitcoin on Tesla and MicroStrategy's balance sheets. Okay, that's one. Two, Genesis Trading, who are doing a significant amount of lending with their loan book now over $9 billion. right? And US inflation expectations, it looks like they're just going to let it ride over 2%. That this opportunity for this Bitcoin that is sitting on the balance sheets of these big corporations now, these big businesses, for cash to be lent out on the back of these massive Bitcoin investments that are being done. And that is significant. And there's a little known thing called wrapped Bitcoin, right? Which is now at 9.5 billion in market cap. It was created as an Ethereum version of Bitcoin to use as collateral in DeFi apps. And I know that's a mouthful to unpack, right? But that where there's in the DeFi world, in order to use a lot of these apps, you need Ethereum, okay? If you've got a huge chunk of Bitcoin and you want to actually use Bitcoin to unlock these DeFi apps, you can convert your Bitcoin into wrapped Bitcoin, which is an Ethereum version of Bitcoin, and you can use that in the DeFi apps, right? There's now 9.5 billion in market cap on that. Now, a lot of my friends in asset management from way back when would say 9.5 billion, so what, right? But these are strong indicators of just digital finance is what I'm calling it. And I think there's a long, long way to go with all this. And, Dogecoin to the moon, if Elon wants to accept that for people to buy a Tesla. Yeah, if he wants to sell lemonade in some lunar base for Dogecoin, then hey, whatever blows your hair back, buddy. But I think there's a long, long way to go here.
No, there is, and like we've talked about it, I just feel like these sort of almost like circus acts on the side just make that road a bit longer towards being more widely accepted. Exactly totally. My sentiments.
Totally. I know. So a couple other examples of how heavy and hot this crypto space is moving right now is that Square's Cash App was reported by CoinDesk back on the 6th of May that they generated $3.5 billion in Bitcoin revenue in Q1.
They're huge numbers. Now, what I found interesting was, and I don't think it was in that article, but I read separately, and then I read something that related to Tesla, whereby I think they only made something like 75 million of profit on that revenue, on that Bitcoin revenue.
It's the way they're reporting it. It. So I think we talked about this last time. The way that Square opted to report it is that the 3.51 billion was just their conversion of cash into Bitcoin. It wasn't actually profit, like you're saying. It's being reported as revenue, but it's not really revenue.
No, yeah. So it was a bit misleading. And similarly, I saw a really good article by Scott Galloway, one of my favorites, talking about Elon Musk, but he was referencing Tesla and Bitcoin. And he was saying that actually in their recent earnings report, if you strip out the uplift that Bitcoin's valuation had and the impact on the balance sheet, there would have been a loss or negative 181 million on the balance sheet. So it's almost falsely propping up the earnings of Tesla. And you could argue, depending on how you look at how Square were reporting it as well, that the numbers and the reality tells a different story.
Yeah. What's going to be really interesting is when a company changes its reporting currency from US dollar to Bitcoin, right?
Surely MicroStrategy would be the first one to do that.
They're nearly there. Did you hear that HSBC banned trading MicroStrategy stock on their personal investing app?
I didn't. No.
Because they said they will not tolerate any trading of cryptocurrency or stocks that are significantly influenced by the price of cryptocurrency because of how much of an investment Michael Saylor from MicroStrategy has commandeered in that business. And that is just beyond.
But did they simultaneously ban Tesla and Square?
No, they didn't.
No, exactly. So,
it's like
that's bullshit.
Total ridiculous. Yeah. The last thing I wanted to mention in this space is Mike Novogratz, Galaxy Digital, right? Mike Novogratz, I think is ex-Goldman. It was probably about 8 years ago, that he saw the potential of the digital asset space and kind of went all in. And they bought the crypto startup BitGo. They're not really a startup anymore. The reason it's worth mentioning is that it's the industry's first $1 billion deal. This was reported by Markets Insider on the 5th of May. And also Jason Yenowitz on Twitter, Simon Taylor shared this, that he went through a pretty interesting example of what's happening with Galaxy Digital buying BitGo and comparing that to the evolution of prime brokerage 30 years ago. So again, a bit of mental gymnastics to get your head around that. But There's a lot of pieces here. And the reason I wanted to mention them is I used them as an example in the Pat FinTech course that I faculted last week, right?
That sounds like a curse word. Is that a real
Faculted.
word?
It's hard for me to say I taught, right?
Yeah.
Because hopefully people learned something. But I only feel like I can say taught if I get the feedback that someone learned something.
Learning. Yeah.
Right?
Fair enough.
So I don't feel like I taught, and I don't feel like I lectured a class because I didn't just stand up there and lecture them. Right?
Presented information.
Exactly. I hopefully got them engaged and, got them thinking about things. So I faculted it, right? Shout out to Andrew Quinn and Larry Gordon at Pat FinTech for accompanying me on that journey the second time. It's a lot of fun. Great cohort, that class. They're a fantastic bunch of people. What I did was I said, okay, play the regulator. If one of these players turns up in your backyard and you don't know that they're operating in your backyard, what is it that you're going to say to them in terms of the regulation that they need to go for? So I gave them a bunch of players. BitGo is one of them because I'm like, all right, these guys are in play. I know that PayPal almost bought BitGo last year. Deal fell apart in December. PayPal ended up buying Curve instead, not Curve, the umbrella card that we all know and love on this side of the pond, but CURV, which is a crypto custody technology provider. But anyway, it had been on my mind, and I kind of picked this one out. To conclude this section is the real mind bender. It was a point from Noel Atchison overall over the last couple of weeks that what if Bitcoin just vanished, right? What if the mask was torn off? Hey, we're a big Ponzi scheme. All of this was just a big joke. Everything will go back to normal, right? I think that's what a lot of minds in traditional finance expect to happen or have their fingers crossed that it will happen. But the fact that when you just ask that question and the ridiculousness of it actually happening almost acts as a validation of this whole space, that couldn't actually happen at this stage, right? My wife is now figuring out cryptocurrency for a couple of things that she's working on. And she's like, Pete, it's just all going to go to zero anyway. I said, it's not.
No, but no, and you're right. I don't think at this stage it's going to go to zero. I do believe that like the biggest risk, and I think it was in the Coinbase S1 before they listed, was that they kind of unmask Satoshi. And actually, I think the biggest risk would be if he was the worst person in the world. I don't know, pick your top kind of terrorist or most well-known evil person out there. And if it happened to be that person, the reputational damage then I think would be possibly irreversible. I think that's kind of the only extreme case of it not vanishing but going to zero is if you find out that, Satoshi was like, I don't know, Saddam Hussein or somebody like that.
Yeah.
Because it feeds into that view that it was for, terrorists and stuff.
Yeah, and I think the widely accepted view now is that Satoshi was never one individual, right? Yeah. Satoshi was a group of people that were able to pull this together. Maybe it was one individual that just took a collection of everybody else's successes and or failures in the 20 years that they tried to come up with something such as digital cash. But no, I do agree that is potentially a risk to this whole space, is that if the unexpected happens, right? Yeah. But that being said, I don't know. I just love the frictionless movement that you get out of this whole space. This episode of Money Never Sleeps is sponsored by Pat FinTech, demystifying fintech and digital finance for financial services professionals. Pat FinTech enable financial services professionals to transform their capabilities into the digital age with dedicated virtual training programs geared towards those that can develop, deliver, and monitor optimally customized user experiences balanced by appropriate governance, control, and oversight. To learn more about Pat FinTech, go to moneyneversleeps.ie/PAT-FinTech. One other thing to mention, it's just been amazing, really, particularly over the last 6 months. And I find myself on my Coinbase app probably way more than I ever had been in the past. And I think the real difference maker here is figuring this whole space out is when you have some money at risk, right? It's kind of like people were always trying to get me to be a Liverpool fan, right? I couldn't just become a Liverpool fan, even though the Fenway Sports Group owned them. And I'm supposed to pick a Premier League team when I move over to this side of the world. And they wear Red Sox. I just couldn't care because I don't have any risk, right? I wasn't born into it. I wasn't brought into it. I just couldn't bring myself to care enough to look at the results every day to see whether Liverpool was winning or losing. And I've got a couple of friends who may be listening to this and they'd be shocked and horrified, especially Damo. But anyway, I think once you have some skin in the game, that's where you really start to learn about this, and you start to see the parallels to traditional finance, but also you see a lot less friction in the crypto environment than you see in traditional finance, but it's only once you're in this space, right, that you do see that. But anyway, probably gone on a bit too long about that. But no, the funniest thing coming out of all of this week, other than, Elon Musk and his mom on Mother's Day, was Charlie Munger with "It's disgusting." I loved it. Anyway, moving right along from things that we've talked a lot about recently, i.e. crypto, to things that we haven't ever talked about before, which is BNPL, right?
Yes.
Which is buy now, pay later. And Klarna is the big name here, okay? Yep. And they stormed ahead of rivals across Europe and the US, counting 16 million new users in 2020. And this was in Sifted on the 4th of May last week. And I'm trying to think, Owen, what is driving the growth here, right? 8 million downloads, might have been in Q1, but was this pandemic induced? What do you think are the societal factors here that will increase the likelihood of someone using a buy now and pay later, an installment option for buying a couch, for buying a TV, for buying, hell, anything?
I think, look, the pandemic obviously accelerated it, especially in the US. We saw a big bulk of those downloads coming in the US market, whereby I think prior to the pandemic, like e-commerce was only 6% of total commerce or something in the US, and it jumped up to 30% almost immediately at the start of the pandemic. People buying things online that they didn't before. But I think it's just the ease at which the integration, because if you go on to, there's some really good examples out there. You just have to kind of Google buy now, pay later. But if you take something like JD Sports in the UK, if you wanted to buy your Liverpool jersey, actually, if you want to buy your Liverpool kit on JD Sports and you're based in the UK, when you get to the checkout, there's like 5 different options. There's Affirm, there's Klarna, PayPal have their own version of it. And it's just all of the offers for you to obviously buy it on credit. And I think it didn't exist really before. In the last couple of years, it's become more widespread, and I think it's just the ease at which people can do it. But the issue there is that it's addressed in the article is that there's a huge amount of defaults, like $200 million worth of defaults, because they're making bad credit decisions. And I have some experience with this from Future Finance days on the underwriting side, doing credit, retail credit for consumers. I'd love to know how they're running those models. There's obviously a huge amount of risk that they're taking there because, for example, they're not going to come and repossess your Liverpool kit. Yeah. So, there's going to be a certain amount of defaults that they expect to write off on any given period. But again, I think it's just the ease of it and the fact that people weren't going anywhere. They had money saved up. But also they're like, well, if I'm going to buy a couch, why wouldn't I split it over 6 payments or 3 payments? Why would I pay all of it now? Yeah. When I didn't have to. And you don't see it. You don't even see it here much. I think Flexify or something, if you go into Harvey Norman, you can use kind of Flexify to buy your iPad or whatever. But those options are kind of few and far between. This is like the point of sale. This is the kind of the battle for the checkout, as it's named Mario Gabriel and the Generalist newsletter that I love reading. He wrote a piece about this and all of the companies that are in the space, PayPal and Affirm, and a few others in the US, and they call it kind of battle for the checkout because everyone is competing to be that kind of point of sale lender because obviously the volumes from an e-commerce point of view are huge. But the issue then, I suppose, with businesses like that is they then need to move up the food chain and start offering other products on the back of that. And that's a tougher challenge for them.
Yeah. It's a massive business. And you mentioned the defaults. It's a lot. It's 200 million. Yeah. Right. And 200 million spread out across over 200,000 retail partners they now have. And I'm trying to do the math in my head, but it's late, right? Like what's 200 million divided by 200,000? I think it's 1,000.
I think it's 1,000. Yeah. I'm looking at the numbers here on the page.
But I mean, that's 1,000 in default per partner, right? I think it's 1,000. Yeah. Add on 3 zeros to the end of that. And you get absolutely. This is awesome. Doing mental math on a podcast. So so it is the average default for every retail partner is $1,000. Yeah. Okay. That doesn't seem like a huge amount when you spread it out.
Yeah. Per partner, could have
like how much
of customers.
How much does JD Sports do in sales in one day? How many Liverpool kits are they selling?
Not that many.
So no, I think when you spread it out, and I think we were talking a while back about the Monzo numbers on some of the lending that they were doing and how those defaults were just ridiculously sky high, up around 20% or something ridiculous, and Starlings were down below, around 5%. But when you spread these numbers out, Klarna's a beast. They got a banking license in Sweden. They've got 64 million customers or 64 million users worldwide, I think, over 200,000 retail partners, like I mentioned. I mean, this is 200 million seems like a lot, but
Does. And the issue here is then it's a completely unregulated space, and that regulation is coming pretty thick and fast, especially in the US. So they've been able to scale relatively quickly. I mean, relatively in the sense that there's been a couple of years growth behind them. But there's going to be some heavy regulation coming from different markets. The EU have their own view of it, and the US has a different view. That's going to really impact on the business and probably tighten up the restrictions. I know we found it even with future finance. Obviously, we were regulated in the UK to lend to students in the UK market, but both from a regulatory point of view and then from a funding point of view, we were restricted to who we could lend to, and the same rules are going to apply here. Obviously, there's someone is funding the lending piece of it, but they're going to have certain restrictions around, whether me or you are good credit or whatever, and that kind of restricts how many times I can allow you to use Klarna in a given year. What's my credit limit effectively, that sort of stuff. So I'd say you're going to see a lot of tightening around the underwriting and the ability to continue growing at that kind of rapid pace that they have been.
well, that's the thing. Is this all around the vulnerable customer regulation?
It'll probably end up being wrapped in under something like that, or
Okay.
to apply some similar ruling to it.
You mentioned future finance, all of this micro lending going on, payday loans, those types of things, right? There is, because sitting on the back end of these platforms isn't just a huge pool of cash. It could be a huge pool of investors who are interested in the higher yields, right?
Yep.
So like Invoice Fair here in Ireland, Flender, I think as well, right? It's investors on the back end that are providing the liquidity so that they get the higher interest rates on this type of, higher risk borrowing. But then because it is all spread out across thousands and thousands of different small loans, that the default potential isn't concentrated. Anyway, I'm not going to get into the fixed income mechanics of economics here, but I think that's the interesting thing, because shout out to Ignacio Coles Vidal from Automated Regulatory Monitoring, or ARM, down in Cork. And they are basically enabling, say, you've got a BNPL player, or you've got one of these micro lending players with, say, 6 million open loans, right? Which is a very likely number. And they can run the numbers to find the potential vulnerabilities in a matter of seconds for 6 million. And you know how these lenders all actually check their own perhaps vulnerable customer risk exposure? They do random sampling of, say, up to 10% of their loan book, and they do it manually.
I know it well.
Yeah. You know it from future finance, right?
Yeah.
So players like Ignacio and ARM are pulling all this together and making it possible. And that's why that kind of clicked for me that, okay, this is another big market for him to perhaps jump into. I'll give him a heads up, but I'm sure he's tracking this. Great guy.
To me, whatever impact the regulation has on it. But then the other question is, how do they move into other product offerings? So how do they move upstream in the customer journey, or I suppose downstream, whatever way you look at it? Because obviously it's point of sale lending. So how does Klarna now sell you more products?
Oh, I think it's data, right? I mean, all this data that they're amassing on the sales channels, not even the sales channels, but the sales data, the sales stats of all these different retailers, right? And they could see how much cash they're bringing in, when they're bringing it in, kind of like my old friends Cabbage, who were acquired by Amex, right? They're able to create all this wonderful data about how small businesses are borrowing, right? Now you've got all this wonderful data about how retailers are selling, right? And you can then turn that around into perhaps offering them credit, and do their, connecting the dots with our supply chain discussion with Starling Bank, expanding it to Europe from a few weeks ago, right?
Absolutely.
There's something there. This is all connected, right? In that they could take this data that they now have been amassing with 200,000 retail partners, 64 million plus users, and turn that into a pretty good indicator of retail sales, perhaps revenue projections, those types of things, to be able to get their head around how they can offer credit to the retailers and go from a B2C offering to a B2B offering, right? So that's my wild educated guess for this evening. Right, so watch the space. A couple other things happening. We talked in the last few weeks about this concept of gross tonnage of dollars, which these big private equity firms are dropping into later stage rounds of big tech startups, a lot of fintech startups. Some of the names in there, Altimeter Capital with their deal in Plaid, Tiger Global Management, Roblox, Coinbase, Peloton, Postmates, Credit Karma, Discord, JD.com, Snowflake, right? They're doing
Right.
something like 4 deals per week. First contact with founder to term sheet in 3 days.
It's crazy.
Right. And this isn't Altimeter, this is Tiger Global Management. And the headline was in Morning Brew, one of your favorites, Tiger Global Management is eating the VC world, right? And they're just turning up in these later rounds and saying, I'll drop 40 or 50 million in. I want to get 10x. When you're a later stage private equity, your model isn't to get 100x, your model is to get 10x. If you get 20x, you're doing well. But if you can get 10x, that's what the investors have signed up for, right? And you get it in a shorter period of time than waiting 100x on a early stage VC fund, you know?
And like you said, the reality is you're not going to lose much by putting 50 million into Plaid at this stage. And it's like putting 50 million into Stripe now. Like, you know, the risk is pretty low. The likelihood is you'll get multiples of your return. But it's interesting to see them moving further down the food chain then, you know, because ultimately there is that element as well of wanting to get that greater return and getting access to some of these companies earlier, you know. I think that's where the speed is one thing. Like, speed is incredible. Deals, term sheets out in 3 or 4 days. They're just banging out valuations and investments. And, you know, they're really showing some of the problems in the VC space when they're just prepared to do it at that speed.
Yep. There's so much money out there right now.
Yeah.
It was Mick Sweeney last year when he was on, he said something, and this was in, August, September of last year, where he said something to the effect of 25 trillion in money had just been created since the start of the pandemic. And that was, you know, nearly 9 months ago. A lot more has been created since then. It's got to go somewhere, right? So either into later stage private market deals or into crypto, right?
Yep.
It's definitely going somewhere. Okay, cool. Couple other things I wanted to mention. We had Ollie Walsh on a couple of weeks ago talking about the crowdfunding raise on Spark, and the Irish Times picked up on that on the 7th of May with them going into their crowdfunding round ahead of their Series A investment. And it looks like they're halfway there on Spark right now, so they're doing well. Shout out to Ollie Walsh. Good luck with the rest of the crowdfunding round. Really want to see you guys do well with that. The Finsight Series going digital in banking and wealth management. Shout out to Rory Galvin. He's CEO of Navirum, and he's a Dublin native now based in Montreal. Also, Niall Toomey, who's Finergo, and Brian Claggett, who's the CRO at Movin', right? We're all going to do this thing on the 27th of May at 11 a.m. Eastern Time, 4 p.m. on this side of the pond. And basically looking at this idea of why should all these wonderful user experiences be relegated to challenger banks, neobanks, right? The second that you or I then go into working with institutional investors or working with wealth level investors, we then bring with us a small forest of documents for everybody to sign. But at the neobank level, everybody can just open accounts with some pretty cool digital identity technology and an app and waving your hand in front of your face to demonstrate that you're not a deepfake, right? So we're all going to be talking about that coming up. I'll put the link to register on Eventbrite in the show notes. I talked to Rory Galvin earlier this week, and he wanted to give us a bit of an insight into the event that we're doing later on this month.
Money never sleeps, pal.
I am the CEO of Navirum. We are a financial services consulting company. We are helping small to medium-sized financial services companies across North America, Europe, to transition to the digital age, essentially. We work with wealth managers, insurance companies, fintech companies to make that leap forward. We've been doing that now for the past 2.5 years, and we're headquartered out of Montreal in Canada, and we have an office in Manhattan as well. We're just about to open a new office in London also and start hiring over there as well. Even though we have clients there, we operate there. We're going to have feet on the ground there, which is exciting. That's our next step. So we are running this event. It's a thought leadership event called the Finsight Series, and we've got some great guests on there, including yourself. We have Niall Toomey from Finergo, and we have Brian from Movin' as well. And we're just looking forward to having a great discussion about where digital banking and wealth management are going in the era that we're in now. What does that mean? And it's going to be hopefully a fun event as well, which is really important.
Awesome. Really looking forward to it. So that's coming up on the 27th of May.
Yeah, and thank you for supporting that. And you can find out details probably on our LinkedIn page is where a lot of it's happening, Navirum on LinkedIn, as well as your Twitter stream, my Twitter stream. Now, tickets are limited and they are flying off the shelf given the speakers that we have, so people need to register early. It's 11 to 12 Eastern. And Pete, does that put us on 4 p.m. GMT around then? So yeah, it's going to be a great chat. Looking forward to sharing ideas and hopefully doing another one, Pete, as well, maybe in September, October, as soon as we can get organized. So
awesome. Thanks so much, Rory.
Money never sleeps, pal.
One other thing I thought was just hilarious. So Chamath Palihapitiya, the king of SPACs. This was in the All In podcast. I think it was last weekend that it came out. He was just going on a bit of a rant at the end of the episode. He said it was something like 1.2 trillion in revenue is expected out of FAMGA this year, right? Facebook, Amazon, Microsoft, Google, and Apple. That makes them the equivalent of the 14th ranked country in the world in terms of GDP. Those 5 companies, the power that they have right now is just off the charts. And he was having a bit of a rant on that. But I thought that was an interesting stat of the week.
Actually, I'll take that stat and I'll see your stat with one I learned today. Actually, I had a call, really interesting hour with the team in Swift. And actually, I didn't know a huge amount about the backstory of Swift, the cooperative, effectively the rails in which everything happens between banks. Didn't know much about it, but actually learned today that Ireland is, in terms of what they call messages, Swift messages, which can be any sort of kind of transactions of any amount or whatever, but that Ireland is like the 8th largest by volume. They're in every country except for North Korea and Somalia,
right,
for obvious reasons. But yeah, Ireland is the 8th largest country by volume of messages that are sent on the Swift network.
That is really interesting.
Incredibly impressive. Yeah.
It is very impressive. And it's with the size of the International Financial Services Center, the IFSC, or the International Financial Sector, whatever you want to call it, here in Ireland, being so overweighted compared to the domestic economy, the domestic financial players, I'm not shocked. No. Right? Because of how many Swift messages are going in and out of the whole funds industry, all of that, something like nearly 5 trillion in assets now looked after in Ireland. So yeah, that volume coming through. I wonder where Luxembourg is on that list, because that would be pretty close.
Actually, I should have asked. Like, I can imagine we could probably guess who most of the top 7 are, but still, it'd be interesting to know who's there relative to Ireland. Yeah. I must ask them that. Yeah, I thought it was a big, impressive number anyway.
I'm sure the eventual country that Chamath forms himself and becomes king of would be up in the top numbers.
Definitely.
Absolutely. All right. Anything else going on in your neck of the woods?
No, I'm giving a talk next week, the 20th. I'll put, if I can find the link, or it hasn't been publicized yet. It'll be publicized tomorrow, so we'll put it in the show notes this week, with the Estonian Business Network around fintech trends and predictions for 2021.
Cool.
With some really interesting players from a number of the local and Eastern European, Baltic region players, fintechs and banks. So looking forward to that. So I've been doing a bit of work on predictions and trends.
Wow.
Brush up, put together the slide deck. Yeah. So that's been keeping me busy now. Plenty to do between now and next week. Get that kind of pulled together for a half an hour slot.
Yeah, it can be quite a lot of work to pull together a few slides for a half hour slot.
Well, what I found is I did some sessions recently on the same topic with TU Dublin. Shout out to Sean O'Reilly. And I really enjoyed that, but I ended up with like 50 something slides, but it got me through the 2 hours with some breakouts in the middle. But yeah, trying to distill all of it down to keep the flow going, not too many words, you know the drill. But yeah, so trying to distill it down even more now to a 20-minute session with room for Q&A. I need to do a bit of work on too much information. That's the issue.
I know. Well, it's better to go into this with too much information than not enough. Over prepare, always good. All right, dude. Yeah. I think we're going to cut it there for this evening.
Sounds good. Pleasure, as always.
Thank you so much, as always. Adios. That does it for this week, folks, and you can learn more about the stories we covered in the show notes on our website, moneyneversleeps.ie. So check us out online and subscribe to our weekly Money Never Sleeps newsletter as well. Also, thanks to Conan Brophy from Create Sound for mixing and editing this episode. Conan is an excellent media man to get in touch with when you're thinking about launching your own podcast. As for me, I'm the founding partner at Navirum Ventures, and I'm an early-stage startup advisor and investor focused on fintech and digital assets. If you'd like to talk to me about your business, drop me a voicemail on moneyneversleeps.ie. Finally, till next time, thanks for listening. See ya!
Money never sleeps, pal.